2026. The world stands at a terrifying and unprecedented crossroads. The peace talks in Islamabad between the United States and Iran, once seen as the final beacon of diplomatic hope, have utterly collapsed. The silence from the negotiating tables has been replaced by the roar of jet engines and the churning of naval turbines. The consequences of this diplomatic failure are now bleeding into the deep blue waters of the Strait of Hormuz, turning a regional dispute into a global survival crisis. This is no longer just a localized conflict, it is a fundamental shift in the world order. As the US Navy moves with surgical precision toward the strait, the threat of a total shutdown of the world's most critical maritime choke point has transitioned from a theoretical risk to a stark, immediate reality. The global supply chain, already fragile from years of post-pandemic recovery and shifting alliances, is facing a 180-degree shift that could redefine modern civilization. With aggressive warnings emanating from Beijing, Moscow, and Ankara, the world is being pushed to the very brink of a third world war. Today, we dive deep into the real geopolitics behind the Hormuz blockade, mapping the institutional money flow across WTI crude oil, gold, and the NAS100, while providing you with the strategic insights necessary to protect your portfolio from this massive impending meltdown. Following the catastrophic failure of the Islamabad talks, the return of the US administration to an uncompromising hardline stance has sent shockwaves through the global community. The order for a total naval blockade by the US Navy's Fifth Fleet, codenamed Operation Epic Fury, has stunned world leaders and market participants alike. Iranian ports are now being caught in a tightening stranglehold, with naval assets repositioning to monitor every movement in and out of the Persian Gulf. This is not a move made lightly. Approximately 20 million barrels of oil, nearly 20% of the world's daily consumption, pass through the Strait of Hormuz every single day. A shutdown here does not just mean higher prices at the pump, it means a systemic explosion in global inflation, a disruption of petrochemical supplies, and a halt to the energy that powers the industrial heartlands of Europe and Asia. The axis of resistance, the network of allies backing Iran, is now stronger and more coordinated than ever before, creating a high-stakes military standoff where the margin for error is zero. The markets are currently pricing in the fear, but they have yet to price in the reality of a prolonged maritime siege. To understand the gravity of this situation, we must look beyond the immediate military theater. We must remember that this is not just a Middle Eastern war, it is a battle for global supremacy involving the world's most powerful nuclear states. China is now the largest buyer of Middle Eastern oil, and its economic miracle is fueled by the very tankers currently threatened by the US blockade. With its national energy security at stake, China is no longer playing the role of a neutral observer. It is throwing its full diplomatic and potentially military weight behind Iran. Simultaneously, Russia sees this escalation as a massive, once-in-a-generation strategic opportunity. By keeping the United States bogged down in a resource-heavy Middle Eastern conflict, Moscow gains a definitive advantage on the Ukraine front, forcing Washington to split its focus and its munitions. Turkey, a pivotal NATO member with one of the largest standing armies in the alliance, has positioned itself sharply against US interests, seeking to claim the mantle of leadership for the Islamic world. Furthermore, the shadow of North Korea looms large, with intelligence suggesting a flow of sophisticated missile technology to the region, turning this regional blockade into a global nuclear threat. This is now a full-scale multipolar confrontation, East versus West. As we transition into the market analysis, it becomes clear that geopolitics is now the absolute primary driver of all price action. Technical indicators are still relevant, but they must be viewed through the lens of institutional risk management. WTI crude oil is currently trading in what we define as a premium area. Specifically, the 97.50 to 98.50 range has emerged as a major institutional supply zone where smart money is actively distributing positions, anticipating a potential peak in wartime hysteria. While the overall long-term trend for oil has been bearish due to slowing global growth, the sudden news of a naval blockade has injected a volatility premium that can cause massive, parabolic price spikes. If the price rejects from the critical 97.50 to 98.30 zone, we are looking at downside targets of 94.00, 91.00, and in a de-escalation scenario, an extreme target of 87.00. The invalidation level for this bearish outlook is a daily close above 99.20. However, if the blockade is enforced, and Iran retaliates, a clean breakout above 98.50 will likely trigger a massive short squeeze, sending WTI toward $100 and eventually the $104.50 level as the world scrambles for physical barrels. In the precious metals market, specifically gold, the current institutional mentality is sell on rise. Despite the headlines, the price is sitting in a premium zone, with the 4,740 to 4,780 range acting as the primary resistance and selling area. We are seeing institutional players drive an internal break of structure (BOS) to the downside on shorter timeframes, suggesting that the initial fear-driven rally may be exhausting. Our primary downside targets for gold are 4,650 and 4,500, representing a return to more stable valuations. However, as traders, we must remain objective. A sustained move and daily close above the 4,800 psychological level would completely invalidate this bearish structure and trigger a massive bullish rally toward all-time highs as the safe haven trade takes full control. Meanwhile, the technology sector, represented by the NAS100, is hanging by a thread at a critical demand zone between 24,600 and 24,800. If this demand level holds, we might see a technical pullback toward 25,100 or 25,300 as investors hope for a last-minute diplomatic miracle. But if the Hormuz blockade intensifies and energy prices spike, tech stocks will face a total bloodbath, as higher input costs and rising discount rates force a liquidation toward 24,000 and 23,600. Navigating this environment requires a deep understanding of intermarket correlation logic. In a crisis of this magnitude, the old rules of thumb are amplified. First, oil up means inflation up. If energy costs remain elevated, the Federal Reserve and other central banks will be forced to keep interest rates higher for longer to combat sticky inflation, which is absolute poison for high-growth Nasdaq stocks. Second, war creates an immediate risk-off sentiment. Institutional funds will liquidate their risk-on assets like tech and crypto to flee into the perceived safety of gold and the US dollar. Third, consider the supply chain crisis. A closed Strait of Hormuz doesn't just impact oil, it impacts the transit of goods and the cost of shipping across the globe. We are looking at a classic stagflation scenario, where economic growth stalls or contracts, while the prices of essential commodities soar. This is the ultimate test for the modern financial system, and the correlations we are seeing today suggest that the market is preparing for a long period of instability. The Strait of Hormuz is no longer just a geographical location, it is now the global trigger point for the next decade of economic history. This decisive move by the US Navy will either successfully deter Iranian aggression and save the world's energy flow, or it will serve as the spark that ignites World War III. As a research analyst with 15 years of experience in these markets, my urgent advice to you is this: do not over-leverage your positions. In a high volatility environment, survival is the first priority. Stay with the established institutional trend, and do not enter trades without clear confirmation from market structure. The current data shows the market is in a distribution phase, making sell opportunities from the premium zones the most logical and high probability path forward. Do you believe the US has the naval and diplomatic power to successfully break the blockade, or will the emerging China-Russia-Iran alliance succeed in breaking the back of the global economy? This is the question that will define your wealth in 2026. Let us know your thoughts in the comments below, and for every institutional grade update, make sure to follow Must Profit FX. Be smart, manage your risk, and above all, trade with logic.